Well, good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Advisor Legacy, and with me today is Todd Doherty. Todd is our M&A expert, and Todd's going to be taking you through the majority of today's content. Before we do get started, I want to spend just a minute going through all the services that we offer at Advisor Legacy. And you'll see here that we have services for advisors that are in all different stages of their career. We have for those that are growing and scaling, those who are trying to preserve their brand, and then those who are trying to leave a legacy. And so the list of services includes acquisition consulting, buying opportunities through our Advisor Legacy sales platform. We offer legal and lending support, continuity planning, and deal support. Deal support is when a buyer and seller have already found each other, but they need help valuing the practice, negotiating the deal, and getting the legal work done. We do a tremendous amount of valuations for the industry, including some of the banks that finance these acquisitions. And we probably do 300 to 400 valuations a year. We offer continuity planning and internal and external succession planning. We represent sellers in helping them find the right buyer for their practice. And then we also offer an escrow service, which is used when financing is being done for the practice. Typically what happens is after the down payment, a portion of the purchase price is held in escrow until the attrition clause has been met. So we want to help make this seamless and as easy as possible for you by handling everything from lending, legal, escrow services, and then the valuations, negotiations, et cetera. So there's really very little that we can't do in the area of succession and acquisition planning. And today's webinar, though, is on business valuations. And so Todd, again, our M&A expert, is going to take us through today's content. So with that, Todd, I'm going to turn it over to you.
Thank you, Tony, and thanks to all of you for taking time out of your schedule to join us today. There's actually quite a number of reasons why evaluation for a financial advisory practice is a requirement. That can be, things like bank financing. Many of the lenders who are SBA lenders will require a certified valuation. If you're entering into a formal equity agreement, certainly that can require a valuation. In other areas that, really you have to find out what the specific value of the practice is. There are also quite a few areas that benefit from evaluation while it's not required. Things like managing the equity in your practice, maybe entering into continuity agreements would benefit from evaluation. And most of those requirements and other reasons to get evaluation are really going to use our standard deliverable, which is based on fair market value. So the value that we're arriving at in that standard deliverable is based on the price that would be arrived at in the marketplace, or the average price between a willing buyer and a willing seller. There are also valuation requirements that need a different deliverable, and those can be items like divorce. That's a very specific valuation deliverable. That's a requirement of the state that the advisor lives in. It could be a partnership dispute, and that might require a valuation deliverable that's based on limited marketability and so forth. And we also do those valuations, and we refer to those as specialty valuations. We have an analyst on our team who is a CPA and holds 2 certifications in valuation, and he handles all of our specialty work that requires something different than our standard deliverable. What you can see on the slide here is really the basis for how a practice is valued. And when a practice sells, the sale is considered to be what's referred to as goodwill. That's the goodwill of the client group. You don't technically own the clients. Of course, they can come and go as they please. But what the advisor does own is the goodwill of the clients, the ability to manage their investment assets and to receive the revenue from that. And when the practice changes hands, it's that goodwill that also changes hands. Because most practices are now fairly large, they have a team involved in them, usually at least one staff member, in some cases quite a few staff and team. There's also an element of value that's known as enterprise value, and that has to do with the efficiencies of the practice or lack thereof, and really how do those efficiencies translate into profitability. So because of the goodwill value and the enterprise value being two different measurements, really, we use two separate approaches of valuation or analysis of valuation. The first approach that we use is what's known as a market approach. And the way that we conduct that analysis is we look at all of the key metrics of the practice, similar items that a buyer would look at in their own due diligence. We compare those key metrics to our benchmarks or averages that we collect from all the valuations that we do. And in doing so, we can determine where is that practice above or below average. And then based on the overall quality assessment, we can compare that practice to previous sales of a similar quality practice. So it's not terribly different to how a home is valued using comparables. And we're really very connected to the marketplace and what price is being paid currently in today's market. The other approach, which again is more representative of the enterprise value, is what's known as an income or earnings approach. And what we're doing there is we're valuing the future revenue stream of the practice discounted for time. The elements that go into that methodology, which uses a discounted cash flow formula, is a growth rate that we assign to the practice based on our assessment of what the long-term future growth might be, a discount rate that discounts the value of the future earnings, and the discount rate is based on both the opportunity costs and risk to a potential buyer. And then we use the expense ratio of the practice to determine what those net earnings will be that go into the formula. So the average of those two different approaches of value is the value that we assign to the practice. And what that number is intended to show the advisor is the middle of the range of actual price that we would see in the marketplace. And again, we have a lot of validation around price because we sell practices, so we get to see in real time what people are willing to offer and pay. And also because of the valuation work that we do for the industry lenders, we're really seeing those deals on pretty much a weekly basis, and it keeps us very connected to what's happening in the marketplace today. When we talk about the market-based approach and really, assessing what the quality of the client group is, one of the ways that we do that is through client segmentation. So what you can see on the slide here is basically a breakdown of the way that we look at client segmentation in the valuation process. So we take the client group of the practice that's being valued, and we break that group really into three different segments. First is what we refer to as basic clients. Those are clients under 100,000 in AUM. The other group is the high value clients, and they're between 100 and 500,000. And then we have affluent clients who are above 500,000 in AUM. As you can see on the slide here, the basic client group for an average practice represents 44% of the clients. The high value group represents 38%, and the affluent group represents 18%. The reason that we really spend a lot of time analyzing client segmentation is it has a very strong correlation to both efficiency in a practice or lack thereof, and ultimately to profitability. And the real key element of client segmentation has to do with the number or percentage of clients in that basic client group. Because as you can see, that 44% of clients produces only 7% of the practice's revenue. So that's quite an inefficient place to be for an advisor, is to really serving almost half of their clients for only 7% of the revenue. At the other end of the spectrum, you can see that the affluent clients, while they're less than 20% of the total, are producing over 60% of the revenue on average. So it's very much a Pareto principle or 80-20 rule, where most of the production and most of the assets are at the top end of the practice. And a very high quality practice, for point of reference, or a very efficient and profitable practice, will have approximately 25% of their clients in the basic client group. And that is very highly correlated to above average profitability. And so we really look at client segmentation as one of the key factors in determining the overall quality of the client group. One of the things that we've done recently is looking at our valuation data, and as Tony mentioned, we do quite a number of valuations each year, so we have a really incredible data set. At the end of last year, we went back and we did a regression study on the data to really figure out, of all of those data points that we collect, which of them have the strongest correlation to a positive valuation result or a negative valuation result. And what we found here is that the three top items that positively impact the valuation, and in this order, are recurring revenue. So the ratio of recurring revenue is the number one correlation to a positive result. Operating profit is number two. And the percentage of high net worth clients, or in other words, client segmentation, is number three. The second and third of those items are very closely connected, as I just mentioned. So those are the items that, if someone wants to manage them and really make improvements in their practice, can have the most impact on valuation. The nice thing about those three positive drivers as well is those are very manageable items. We've seen people make really significant differences in value by improving those after they've identified in evaluation that there's room for improvement. On the other hand, the negative value detractors are the number of low value clients, so sort of the other side of that coin in terms of client segmentation. The average age of the clients is a very significant factor, and becoming even more so as a lot of the advisors are aging, and so are their clients. When those clients, and especially the high value and affluent clients, get at or near the average age of 70, that can be a real tipping point in respect to the value. And specifically because it becomes a bit of a challenge to have any type of a growth assumption with the client group of that average age. And then lastly on the list of negative detractors is the number of professionals in the practice, which might seem a little counterintuitive, but the reason that the number of professionals can negatively impact the value is due to the operating expenses. Generally speaking, where you have quite a few professionals in the practice, you also have a very high operating expense ratio and significantly decreased profitability in some cases. So those are the items that are really driving value in either direction. And as I mentioned before, many of those items are very manageable. And so getting evaluation and then taking the steps to follow up on the results can really have a significant impact on your valuation and the value of your practice over time, and especially, coming to the time when you're ready to monetize that equity. We did an interesting study as well that you see on this slide by taking two practices that would appear to be quite similar in respect to both their production and their assets under management. And what you can see on the top of the page is that practice number one has production or GEC of 619,000. Practice number two is virtually the same at 621. Number one has assets of 70 million, practice two of 74 million. And these are actual results from two separate evaluations. But then if we apply the positive and negative factors of valuation that we just reviewed on the two previous slides, you can see where these practices that appear to be very similar start to really differentiate from each other. So if you go to the number one item of recurring revenue, practice one has 86%, which is about average today. Practice two has 96%. Really significant differences in profitability, 22% versus 57%. Again, client segmentation is much stronger for number two. And then in terms of the negative factors, you can see, client segmentation is again much stronger for practice two. The client base is considerably older, although that's pretty close to the average for number one, but number two happens to have a fairly young client base. And then the number of professionals varies quite a bit as well. So while we started out with, two practices that seem very similar, what you can see at the bottom of the page is a very, very different result. The first practice came in at just around $1 million. Second practice came in at $1.7 million, and that's a very significant result. And it really gets down to, what is the impact of those key metrics that both drive and detract from value. Just as a side note, we had a practice we did a valuation for at the beginning of this year. The advisor had a valuation completed in the same time frame the previous year. His practice was pretty similar to practice number one, a lot of opportunity for improvement. A lot of the metrics were either average or maybe slightly below average in terms of efficiency. Came back a year later, made the changes to look more like practice number two, and that specific advisor was able to increase the value of his practice by $1 million in a 12-month period, which is just a really incredible result. And it really shows you, how much efficiency can impact the value of a business. And most of that change in value was due to efficiency and not necessarily the growth of the revenue. Another way to look at that range of value is really based on our average valuation result and applying that range to it. So what you can see on this slide is that of all of the valuations that we complete in approximately a year, an average size practice of those valuations has revenue of $789,000 and AUM just north of 100 million. The average valuation result for that practice is a multiple of the gross revenue of 2.06, or a different way to look at that result is as a percentage of AUM was 1.57% of AUM. And again, that's just a way to express the result and as a multiple of revenue or AUM. Then when we take that average practice and apply the range by looking at the top 20% and the bottom 20% result, you really see how significant the range of value can be. So a top 20% result applied to that average size practice gave us a valuation of $1,819,000, and the bottom 20% result was $1,433,000, or a range of almost $400,000. So hopefully you can see in this range of value too why, using rules of thumb or, basic multiples of revenue, which advisors often do, is not a good idea, because unless the practice was exactly average, you could certainly be off pretty easily by a few $1,000s or even by $100,000 or more, depending on the practice, whether it's, better or worse. And certainly far exceeding the cost of evaluation. So, knowing the precise value, excuse me, is extremely important. A little bit on our own valuation process. I talked about the two methodologies of value. And as you can also see on this slide, our standard valuation is $12.95. We put quite a bit of time into making the data collection as painless as possible. So what you do in our process is you'll complete a questionnaire online. The questionnaire will also help correct some of the data points if you're putting in data that doesn't add up and so forth. And that should speed up the process a bit. At the end of the questionnaire, you'll upload reports regarding the assets under management and the production for the trailing 12 months. And then the other item that we ask for is the financials of the practice, which can be provided by a tax statement or a 12-month. Once we've collected the data and that's completed, we'll generally deliver the valuation within 7 business days, which is quite a bit faster than most of our competitors in the industry. We realize that when someone orders a valuation, they probably need it as soon as possible. And then what we'll also do is we'll schedule an hour to go through the results with you. And I think that's one of the areas where people find really a lot of value in our process specifically. We don't want people, getting the deliverable and flipping to the page that has the value on it, and that's the extent of it. Because if that's what happens, you really didn't get what you paid for. So we want to make sure that we go through the results with you, explain, where the opportunities are, why we arrived at the value that we did, and really help you use that information to achieve the goal that you got the valuation for. So that's our process, and now I'm going to hand it back over to Tony to wrap it up for us and open it up to any of your questions. Thank you.
Well, thank you, Todd. For those of you who are interested in purchasing one of our business valuations, you can go to our website at advisorlegacy.com, and at the top you'll see services, and when you click on services, you're then going to see this list of services below here, and so you'll then choose business valuation on the left-hand side. Once you get to the next page, it'll give you the opportunity to put a credit card in to make the purchase. So the way the process works is you buy it online with a credit card. You're then going to receive an email with instructions on how to complete the questionnaire. And then there's a simple data collection process. And then what happens is we deliver the results in about a week. So you get a copy of it by email. And then we're going to schedule the one-on-one consultation. So what I'd like to do is open it up to some questions. You have the ability to type in a question through your chat functionality on Zoom. So if anyone has a question, if you could type that in right now, now would be the best time to do that. While we're waiting for a few questions, let me just read a few quotes from some advisors we've done business valuations with. The first is from Randy Kreinbrink. He says, my experience going through the evaluation process versus the other company was night and day. This is also true for format and clarity in the deliverable. I can't believe the difference in the amount of time required and the level of my frustration between the two processes. Thanks again for your help. In other words, our process is very simple, it's quick, and very comprehensive, and the deliverable is better. A few other comments. First one is by Jim Mumau. Jim said, I did not go into the process with having high expectations about this being a valuable tool for me personally. Having said that, I found the business valuation more valuable than I ever thought, and that the hour with Todd and I spent together reviewing the results, some of the most valuable time I've ever spent looking into my practice. So if you want to get a hold of Todd, you can see his contact information in the bottom right-hand corner of your screen. It looks as like we do not have any questions today, so I'm going to go ahead and wrap it up and thank everyone for joining us today, and hopefully you learned a few things about business valuations.